All right, well, good afternoon, everybody. Welcome. I suppose it's afternoon for most everybody on. I guess good morning to those joining us from the West Coast today. Good to be here virtually with you guys. My name is Jason DeBono. I'm the Vice President here at NuView Trust Company. And today we're going to walk through, in my opinion, one of the most advantageous retirement type plans that exists for those that are self-employed, and some of the end of year tax strategies that we should be considering. So as we go through this today, feel free to ask any questions that you have. I would ask that you do it through the chat or the Q&A. I will see those. If it looks like I'm clicking on stuff, it's just to make sure that that all the questions that have come in have been asked and addressed. So definitely want to make sure we get to as many of those as we can today. We'll go through this relatively at a good speed, and we'll make sure that we cover really the whole gamut so far as everybody on the call is concerned, in terms of understanding what the options and availability of plans are for those specifically that are considered self-employed, and we'll talk a little bit about what that looks like here as well. So without further ado, we're going to go right through it. Remember, if you do have questions, you can use the chat or the Q&A functionality. Those will both hit my screen here, and I'll gladly get those addressed and read aloud. So let's get started. All right, so number one, I want to make sure, and for those that have been on anything we've done in the past, you're probably pretty familiar with this slide, and that is NuView Trust is not an attorney, legal, or accounting and tax firm. We are a financial services firm that provides custody of alternative assets inside retirement accounts, but we do that in a passive way. So even though we're going to talk about tax saving strategies and structures, we're not your accountants, we're not your attorneys. If you do have questions about how you earn your money, whether you qualify, we can get you close, but we cannot tell you, yes, you qualify, or no, you don't. Again, that's just not our role. Our relationship with you is not deep enough to understand how you make your money, specifically how you file your taxes. That's what your tax professionals are for, to validate that. And then same thing on the structure and investment side. We can tell you what we see and what we're accustomed to, but whether or not that's the right legal structure and strategy for you, that's only between you and your legal counsel. So let's talk a little bit about NuView. Who is NuView? What do we do? So NuView is a full service regulated public trust company. This is very important because you're going to hear a lot today about a plan that we call the Solo Qrp. It's referred to as a solo 401k, an individual 401k, but it's basically an owner-only plan. It's designed for businesses that don't have any common law employees, and I'll touch on that. But why it's important to understand why a full-service regulated public trust company is critical is we don't sell any one particular plan. We are one of very few public trust companies in the country that are full service. That means that we can set up and structure both Solo Qrp accounts, we can hold self-directed IRAs, we can hold checkbook control IRAs, we can hold non-qualified money, meaning non-IRA money for certain trusts and organizations as well. So the reason that's critical and important for you to understand is that we're not biased. We don't have any sort of opinion on what plan you should have, or we don't sell you one plan versus another, because we can service you no matter what your strategy and structure desires are. Unfortunately, in the marketplace, there are companies that only sell the Solo 401k plan, the Solo Qrp plan. So they're always going to make it sound like that's the only plan that's worthwhile. There are groups that only sell checkbook control. They're not a trust company. They're not regulated. They're just a group that is out in front of an IRA custodian like us, selling a product and then referring you to someone like us to custody the account. So I'm not saying those companies are bad. They're specialized and they can be valuable for you, but understand and take all the information you get from anyone with only one ability to provide you service with a grain of salt. So here at NuView Trust Company, we are one of the few full service public regulated trust companies in the United States that does serve the Solo Qrp, the IRA, self-directed IRA, the non-qual, as well as checkbook control. So we've got a lot of experience in that. We've been doing it over 17 years. We've got, that number actually is now over $1.5 billion of assets. We are a publicly chartered trust company in the state of South Dakota. We have a compliance office there. And then our servicing company, which is the picture you see on the screen, NuView IRA. All of our servicing is done out of our Longwood office in Florida, just outside of Orlando here in sunny Florida. And our goal is to be simple, available, and responsive. We want you to be able to do business with us, and we want to be able to communicate with you and effectively, chat with you about what it is that you're looking to accomplish. So, moral of the slide here is to understand that we've been doing this a long time. We service lots of customers, and for the most part, We certainly know what we're talking about, and we're not driven to any one strategy because it's what we sell. We're driven to help you figure out what strategy and structure makes the most sense for you. Regardless of what that is, we can be your custodian of those assets. So let's kind of talk a little bit about the way that self-directed accounts work as a whole, and then we're going to hone in specifically on the Solo QRP. But the issue that most people have is that they don't know how to save, and for those that do save, they're saving generally through some sort of vehicle that's stock market tied. And the challenge that a lot of people have, especially those that are self-employed, is they don't want to put their money into a 401k that's going to sit in stocks and bonds. It doesn't mean they're not interested in holding those as an asset, but we find that a vast majority of self-employed individuals want more control. And the problem is you end up in a game that it's hard to control the outcome, right? It's like sitting at the blackjack table. And I think for anyone that has watched or followed any sort of the economics of what's going on as we kind of navigate through a pandemic that's really swept our nation and world over 2020, it makes absolutely no logical sense that we have businesses shut down and we have all this stuff that's closed and all of these challenges, unemployment numbers through the roof, yet somehow the stock market is achieving all-time highs. And it's really hard for us to look and say, yeah, that's the reality. And so for many people, it doesn't mean there's not investment opportunity there, but it's very hard for people to play that game. So when we're in the stock market exclusively, and one of the things we're going to talk a lot about today is the value of this Solo QRP account and being able to not just access public securities if that's where you want to be, but more importantly, give you the full gamut of control, even outside into the into the privately traded world. So the other thing that I want to talk about too, and make sure everyone understands, is that when you decide to save money, there's lots of ways to save. And so for people that are self-employed, they tend to be one of the worst groups for saving. And there's some good, reasons why, and then there's just simply some okay excuses that self-employed people like to just say. The reality of saving is that you have to do it, whether you like it or not. And if you're self-employed, it is a little bit harder, because at times it can be feast or famine, right? You have years you make a lot of money, and you have years you may not make any money, and years you lose money. And that sometimes is the danger and opportunity that comes with being self-employed. But I hear all too often from individuals when they say, well, I don't have a retirement account. I own 10 properties, right? I'm a realtor, and that's my retirement plan. And I want to make sure everyone understands there is a stark difference between a retirement account, which is a vehicle, and real estate, which is an investment. And they're two completely different things and should be considered and thought about and evaluated independently of each. So before we sit and talk about investments, I want to simply rise us back up to about 50,000 feet. And I want to talk about accounts, because how we structure these accounts can have a significant difference on how we actually buy investments and how much of the investment return we get to keep. So I'm going to walk you through the power of why your investments mean a lot less than the account themselves. So if I were to go through, and I'm going to just walk you through two different scenarios, right? And this is very simple, and you'll kind of get the idea of it, but it'll help you understand the value from an account standpoint versus an investment standpoint. If I were to give you $1 today, 2020, and we were going to double it every year for the next 20 years. So 2021, it becomes 2, 2022, it becomes 4, 8, 16, you get the idea. That's the investment, that's the time, and that's the starting amount. So we can always get to future value of money by knowing how much we start with, what's our rate of return, and how long are we going to hold it. So $1, rate of return is 100% return, or doubling every year, and the number of periods is 20 years. What we don't know, and what we tend to ignore in our calculation, is we do the math on that and kind of assume that the end number is what we have. What we don't take into consideration is that if we make this dollar investment doubling every year for 20 years in a taxable account, then it's really not going to double every year. It's going to double, then I got to pay tax, then that's going to double and I got to pay tax. And what we don't tend to consider is how much impact that has in our actual rate of return and how much money we're left with at the end. So if we take $1 and we double it 20 times, right, year over year, and we do it assuming that we're in a taxable bracket of 25%, you'll see the math here on the left side of the screen, and it basically says at the end of 20 years, you'll have $72,570. Now, for most people, you would go, whoa, that's incredible. I can take $1 and 20 years from now and have $72,000. Everybody would suggest that's a great investment. The problem is you don't realize how much that 25% tax actually costs you, right? You think that if you look at it the first year, it costs you a quarter and then it costs you 40 cents. But what you don't realize is over time how that compounds and how much it really costs you. And I'm going to illustrate that for you. So if I wanted to look at the way that investments work, and I like to share kind of a very simple philosophy, and that is you invest, right, to make money. Right? So your investments make you money. Your structure and strategy is what makes you wealthy. So if you're just looking to make money, what you see on the screen is not bad. If you're looking to build wealth, then you need to couple this alongside good structure and strategy. So I'm going to walk you through the same exact investment, same dollar, same 20-year period, same investment return, doubling every year. But instead of paying tax on an annual basis, we're going to structure this inside a self-directed retirement account, which is tax deferred or tax free. So I'm going to take the same dollar and I'm going to make the same investment over the same time period. So all things are equal. But the only thing between the person that makes money and the person that builds wealth is that the wealthy person realizes that, yeah, I can make good investments, but how do I keep the maximum amount? So they set up a self-directed account. And if you look at the numbers, those are real numbers. You can do the math yourself. At the end of 20 years, I'm going to end up as a wealthy investor with $1,048,000, and you're going to end up as an investor that just simply tries to make money with only 72 grand. Now, I want you to focus on a few things here. The investment is identical. The strategy is identical. The time you hold the investment is identical. And the amount you have to invest is identical. There is only one inherent difference here. And that is simply the structure and vehicle by which you make the investment. So if you are self-employed and you believe that you are going to build wealth by simply buying investments through your company or simply adding money to your company, that's an element of it. And I wouldn't argue that there's not value and merit to do so. But if you do not have a tax advantage vehicle that you are utilizing to put money away and eliminate Uncle Sam from your investments on a go-forward basis, you are leaving, based on my example, almost $1 million on the table. So again, I'll ask you, do you want to make money or do you want to build wealth? And if you want to build wealth, then you have to understand that the tax advantage investment opportunities that lie ahead of you are going to be critical to get there. So this is one of my favorite slides because it just illustrates how important kind of that item is that we don't see and touch and feel, but it's there. And look at the impact that it has on our investments. So let's talk about the accounts that exist, and we're going to hone in specifically on the bottom one there, which is the Solo Qrp. So some of you may be using the traditional and Roth today, and that's great. A lot of you may be using a SEP, which is a great self-employed plan, but it's not as good as the Solo Qrp. We're going to talk about health savings accounts and ESAs for those of you that have high deductible health insurance, which is very common for those that are self-employed, as well as ESAs as a ways to use tax advantages to pay for education. But we're going to hone in and spend the rest of our time today talking specifically about the Solo Qrp, the why, the how, and ultimately what this plan does and how it functions so that you can take full advantage of all the opportunities that it presents. The first thing that I want to highlight is that in a Solo Qrp, it has the highest amount of contribution eligibility. It is the same as a SEP IRA from a total contribution standpoint at $57,000 per year. But what a Solo Qrp has that a SEP doesn't is it has employee deferral as well. So in a SEP, you're only allowed 25% of your self-employed income. So if your eligible income is $100,000, you can only contribute $25,000 to a SEP IRA because it's 25%. The same $100,000 of income in a Solo Qrp is going to give you the 25% plus 19.5 as an employee. So you can contribute 19.5 as the employee plus the 25% as the employer. So now your maximum contribution to this plan, instead of being 25, is actually 44,500. So it accelerates your ability to contribute, making it easier to get to the $57,000 maximum versus a SEP. So we're going to walk through and talk about this plan in great detail. Remember, if you do have questions, please pause and get those entered into the chat or Q&A function, and I will stop and get those read aloud. So I mentioned this, but let's kind of walk through this in detail. Well, the beauty of a Solo QRP is it works just like a 401k plan. So if you think about how a 401k plan works, is you have an employee contribution that you get to make, and then your employer contributes as well. The drawback that most self-employed individuals have is that when they're self-employed, they have to create the 401k. They have to go through all these hoops. They don't work for AT&T, where AT&T has handled all the heavy lifting for you. And the challenge that you run into is that you don't get to it, you don't do it, and you leave all of that tax deferral on the table. So setting up a Solo QRP is very simple. It was created really and came into fruition with some tax law changes in the mid-2000s. And it basically said, we will extend, Congress extended all the 401k benefits and actually created exemptions for a lot of the headaches if you don't have any employees. So what it did was it took the idea of a 401k being kind of traditional employee based and said, we're going to extend all those same benefits to someone even if they don't have any actual third-party employees. And by not having third-party employees, we're going to simplify the administrative burden on these plans. So by simplifying the administrative burden and making it accessible, this is really a plan that if you are self-employed, there's zero reason you wouldn't have it. Whereas back prior to the legislation, it was cumbersome. It was a lot of work. It's a lot of headache. And we'll talk a little bit about that as we go through this today. But by setting up this plan, you give yourself the ability to contribute as the employee up to $19,500 plus another $6,500 if you're over 50. And then the employer can, and it actually is, we call it a match just to help you understand it, but it's not a match. It's simply a designated employer deferral of up to 25%. So your ability to sock money away into these accounts is significant. And as you can see in 2020, it's actually up to $63,000 of contributions. So the opportunity is grand. And it's one that allows you to put the most money away. But that's really just the tip of the iceberg in terms of why this plan makes the most sense. As we continue to move forward, let's talk about kind of what that looks like. Well, when you're looking at the different plan types, you can go out and you can get a Solo QRP account from Fidelity and from Schwab and from TD. The problem is it's what's considered a brokerage-based account. It means that they'll give you the plan, right? But they're going to force you to invest the money through them into brokerage assets. And the drawback to that is you're forced into that. A self-directed account means you can still buy brokerage assets, but you get your plan from NuView and it's an independent plan provider. You get your plan from someone that doesn't force or limit your investment choices. So if you want to buy a piece of real estate, great. If you want to issue a private loan, go for it. If you want to also own some public securities, you can certainly do that as well. So it's actually taking the idea of just a brokerage alone, and it's really brokerage plus in the self-directed world. Some additional benefits here, there's a lot of things that you can do inside these accounts in terms of designating what bucket or pot of money owns the investment. You can make Roth conversions inside. So we'll talk a little bit about that. But ultimately, a self-directed Solo QRP plan gives you full and maximum control, a checkbook for the bank account, and then you can go invest it into public or private securities as you see fit. And that certainly is very attractive. So who qualifies? Well, the very simple litmus test is are you self-employed? Now, the way that that's defined is, do you earn money in the eyes of the IRS that would be considered self-employment income? So there's some ways to look at this. We always recommend talking to your tax professional. We're not experts on this, right? But it doesn't matter if you're a 1099 or it doesn't matter if you're set up as a business, an LLC, a sole proprietor. That has a lot of less impact. What matters is how do you actually report the earnings of that enterprise? And if you report it in a way that's considered self-employed, right, or especially if you're paying self-employment tax, then it is considered self-employed income and you do, as a general rule, qualify. The second thing is you cannot have any common law employees. Common law employees would be anyone that is not your spouse or anyone that does not own at least 5% of the business. So for example, if I owned a company 100% and I got paid by the company, right, and my wife got paid by the company, we could set up the Solo 401k QRP plan for that company, and I, as well as my wife, would both be eligible. We would not meet the criteria of needing a full-blown 401k plan because we don't have any common law employees. In the eyes of the IRS, I'm not an employee because I own the business, and my wife is not an employee because she's my spouse. Now, if she owned 5% or more of the business, then she would also meet the criteria to be excluded because she owns more of the business. But let's assume she wasn't my spouse. She was just a good friend. If I employed her in this business and she did not own 5% or more of the company and she was not my spouse, then I wouldn't qualify for the Solo QRP account because I now have a common law employee. So you can exclude any employee from being considered common law if they're a non-spouse, if they own less than 5% of the company, or if they work over 1,000 hours. If they meet any one of those three criteria, or sorry, two of the three criteria, including 1,000 hours, then technically they are a common law employee and I no longer qualify. But if I own a business alongside 4 other people and we each own 20%, even though we're all employees of the company, we don't have any common law employees because there's 5 employees, 5 people that own over 5%, and there is no common law issue. And the logic behind this, if you can ever, kind of determine logic when it relates to what Congress and the IRS put out, but there is some logic here, and it basically says this. The IRS is not concerned about how you treat your employees if it's a spouse or they own more than 5%. And their logic is because of that, they're not going to consider them a run-of-the-mill employee. For example, they're pretty confident that the way I would treat my spouse as an employee would be a lot different than I probably would treat just a run-of-the-mill hired off the streets employee. And what they're concerned with in 401k plans is they want to make sure that everyone's being treated the same. That's why 401ks, full-blown 401ks through employers are a headache. They're a lot of work. We have one here for our employees, and it's a great plan, and we love it, and we'll continue to offer it. But administration is a burden. But if you qualify for the Solo QRP, you get all of the luxuries of the plan and very little of the burden. Again, there's no burden because you don't have any actual employees. And that's really what makes this plan tick and work. So you cannot have any common law employees, and you can set this plan up regardless of how your business or self-employed income is structured. If you're a sole proprietor, if you're an LLC, a partnership, a C Corp, an S Corp, either way, it doesn't matter. It has to do with having self-employed earnings. So how do you get money into these accounts? Well, one way is to take old 401k-like plans, 401k, 457, thrift savings plan, 403bs, and move those accounts into your new plan. So if you work for the government and you have a 457 plan, or you work for AT&T and you have an old 401k, all of those plans can be moved in to your Solo QRP. If you have IRA accounts, traditional Roth, simple, you may, with the exception of the Roth, be eligible to move those into your new qualified plan. So your Solo QRP can actually take, if you have $100,000 in your IRA, you can move that $100,000 into the Solo QRP. You cannot move Roth IRAs into the Solo QRP. That is not an issue with our plan. That's simply an IRS mandate that for whatever reason, they closed that off when they created these plans and never opened it up. We kind of joke that they probably should have done this in 2008 when they allowed Roths to be contributions to 401ks, but they simply do not allow this yet, and hopefully that will change. So if you have 401k money, you can transfer it, whether it's Roth or pre-tax. If you have IRA money, you can only move it into the Solo QRP if it's pre-tax, traditional, SEP, or simple. And then, of course, you can make your annual contributions to the account. I'm going to pause there and see if we've gotten any questions. Now would be a great time to ask any if you have them. All right, I don't see anything coming in, so we'll keep moving along. So what are the benefits? Well, we already talked about benefit number 1, and that is that slide that talks about the difference of having $72,000 versus $1,048,000. The benefit of any retirement account or tax advantage plan is simply the tax savings on an annual basis. It's either tax deferred or tax free, and in either case, it's significantly more powerful and will yield you far better results than any traditional sort of taxable account that you may be investing through. So when we talk about benefits, one of the first ones is accelerated contributions, right? I use the example in a SEP where I can only contribute 25 grand if I make $100,000 of self-employed earnings. Whereas in a Solo QRP, I can put in the 19.5 plus the 25%, right? Giving me $44,500 of contributions instead of 25,000. So that acceleration. Second thing is it has the highest amount of Roth contributions. So I can contribute $19,500 directly to my Roth on an annual basis. I cannot do that. The max I can get into an IRA is $5,000 or $6,000, or sorry, $6,000 or $7,000 a year. So my ability to contribute 3 times what I can in an IRA, all straight into my Roth, is very powerful. Asset diversification. So the plans that we offer are fully self-directed. So you get the best of both worlds, right? You get the plan that makes tremendous sense, and then you get the structure and strategy from an investment standpoint that is not simply tied to brokerage assets. So you have a lot of opportunity there. Additionally, you can borrow money out of your own plan. So this plan has a loan provision for up to $50,000 a year, or 50% of your account balance, the lesser of the two. So if you have a $200,000 Solo QRP, you can actually borrow personally up to $50,000 a year. It's paid back over a 5-year term, and you can use the money for whatever you'd like. The reason this is very powerful is that if you're self-employed, you're all too aware of the fact that sometimes there are cash flow issues, or sometimes your business slows down, or sometimes a pandemic rolls through and your ability to earn money in your business may be challenged. And so knowing that you have a $50,000 safety net inside your own retirement account to go capture makes it very easy to put money in here year after year, because if you do run into an issue and you have to go get it, you have immediate access to up to $50,000 or 50% of that balance. It is also a great plan if you plan to buy real estate and use leverage. So in an IRA, you can buy real estate and you can go get a non-recourse mortgage. That can be a great strategy because the power of leverage boosts accelerates your ability to generate return. The problem is because you're using leverage, sometimes in an IRA, leverage can be taxed by the IRS. Well, in a Solo QRP, leverage is not taxed in a Solo QRP. So if you're using your Solo QRP to buy property and taking on debt, acquisition debt, you can actually do that without having any tax liability from a UDFI standpoint. So we have a lot of clients that realize that they're making a leveraged investment, and simply moving account types will save them the UDFI tax. That alone would almost be worth making the choice to move to a Solo QRP plan. And then there's no commission to NuView. So you'll pay us a fee for the account, but as far as commissions and other things go, we don't make any money off of the investments that you go out and direct the account into. So there's a lot of opportunity there for you to, again, save some money on what would normally be pulled away in the form of commissions. Some basic rules in a Solo QRP, pretty straightforward. You cannot purchase life insurance, although there are some exceptions to that, and you cannot purchase collectibles, antiques, artwork, etc. On the other side, you cannot invest with anyone that's closely related to you in your family, right? The trunk of the family tree. You cannot invest, whether you loan money to, buy something from, etc. You cannot invest in any way, shape, or form with yourself, your spouse, your parents and grandparents, your children and grandchildren. So you can make investments alongside those groups, but you couldn't go buy something from your dad with your own Solo QRP, because that would be considered prohibited. I saw a question pop in here. Let me pause here and get that addressed. The question says, can I make passive real estate income self-employment income? If so, how? So I'll answer this with a big asterisk, right? Based on the first couple of slides, I am not an accountant. But typically, passive real estate is not considered earned income or self-employed income because it's filed on your tax return as investment income. What I have seen and what I understand, and there may be better ways to skin this cat, what I have seen for people to do that, to generate actual self-employment income, is they take the money into an entity, right? And then the passive income comes in, and then the individual, in this case you, would be the property manager of that entity, and you would oversee those assets and be paid a fee for overseeing those assets. So how you structure that is up to you, but typically we see that very commonly, and you'll pay yourself enough self-employed income to not get hammered with taxes, but to also give you a means to contribute on the out, to a solo QRP. So you'll have to find a balance there, but typically anytime you own real estate, it probably needs some sort of property management and maintenance, and you can certainly fill that role and earn a fee for doing that. And that fee could be paid to you in a 1099, generating you self-employed income. It could be structured in an LLC, and then all the income comes into the LLC, and then you're an employee of the LLC. And the LLC sets up the Solo QRP. There's a lot of different ways to get there. Those are just a couple of ideas. I appreciate the question and hope that you guys keep them coming. So what can you do with the Solo QRP from an investment standpoint? Well, I mean, as you can see here, it's pretty open-ended. Real estate, mortgages and notes, and private placements and private stock and partnerships and LLCs are the three biggest, right? So private entities, private real estate, and private notes are the three categories that we see the most. You can buy stocks, bonds, and mutual funds. That's fully accessible to you. You can buy precious metals if that's something that you're interested in. But really, the sky is the limit. You just can't purchase any sort of life insurance or collectible. So let's kind of close out here, and I'll certainly stick around for questions, but with some additional what we call kind of bonus categories to consider. One is the Roth conversions can be done directly inside the Solo QRP. So if you have money in your Solo QRP, you can convert that inside the plan, and you actually want to convert it inside the plan. If you convert it outside the plan, it may cause you issues getting it inside the plan. So for example, if you have $50,000 in a traditional IRA and you convert it to a Roth IRA today, that money, now that it's in a Roth IRA, is no longer eligible to go into the qualified Solo QRP. If you were to simply take the traditional, not convert it to a Roth, move it to the Solo QRP, you could do the conversion inside the plan. So there's some strategies there that you want to be very, very aware of and very careful with. But the whole goal here is to try to get that money into a tax-free state, but make sure that you're doing it without creating eligibility issues to get more money into the Solo QRP. The health savings account, the reason that one's on here is because many people that are self-employed struggle to find decent insurance. And so you don't have enough people to get a policy that's subsidized by the insurance provider. And you also don't have any sort of purchasing power because you're buying a plan for one or two people. So a lot of times what happens is the insurance, to keep the premiums lower, most self-employed people have high deductible health insurance. Great program, great plan. If you have it, you can also save tax-free right alongside that in what's called an HSA. So this can be a very, very good strategy for many of you. If you want to continue to save and keep opting to put money away, you can do so through that health savings account and actually build tax-free growth that you use to pay for your medical expenses. The last plan to talk about is the educational savings account. This plan allows you to put money away for an individual's education expenses. So we kind of use this as, hey, give the gift of education. Kids, grandkids, you can take $2,000 a year and put it into their account on their behalf. And that money can be put into a self-directed ESA, and it can invest. And as it turns profit, that profit goes back into the account and can ultimately be used tax-free for qualifying educational expenses. It's worth noting a couple of deadlines. The deadline to set up your Solo QRP is December 31st. So if you have not done that yet, make sure that you set it up and do so. Also due December 31st is your employee deferral. So if you want to make a contribution as an employee, you have to do that by 12/31 or a very short period thereafter, a couple of days. If you don't, set this plan up, then your 2021 is out of the picture in terms of eligibility to contribute. So if you want this to be a 2021 tool, then wait till 21 to set it up. But if you want to get the benefits of this plan in 2020, you get the full year's benefits, even though you're opening it the last week of the year. HSAs and ESAs have a look back provision, meaning you can look back to the previous year to make the contribution. So you have up until April 15th to look back. However, for a health savings account, if you did not have a health savings plan set up in 2020, you cannot contribute in arrears. So if you're thinking that if you're on high deductible health insurance today, you have until April 15th to decide. If you're not, but think that you may want to, I would suggest making that decision by 12/31 and giving yourself this year to contribute as well. So a couple of little strategies there. You know, we kind of laugh, little bonus content we want to make sure that you're thinking about before we wrap things up. All right, I got a question that came in. It said, I currently have a 401k at NuView with real estate. I have some residual funds in the account. Can I invest that residual fund in equities, or do I need to set up a different account? Can I have both the QRP and 401k at the same time? So we use the terms interchangeably. That's just marketing at its finest. 401k and QRP work the same. If you want to buy public securities inside your current 401k plan, you have the ability to go do that today. What you're going to want to do is go to a Schwab or a TD, some trading platform, and open up just a simple brokerage account. You're not going to open a 401k account because you already have the 401k in the account. You just need a brokerage account, and when they ask you for the name of, the owner of that brokerage account, you're going to put the 401k's name, show them your 401k paperwork, and you shouldn't have any issues at all. So it'll allow you today, there's nothing stopping you from using your residual cash to buy public securities, other than simply finding a brokerage firm like a Schwab or Fidelity that will do it for you. Any other questions? Now would be a time to ask them as we literally get to the last screen here and get to closing. So, the goal of this presentation is really to help you understand just some basic nuances and general overview of the Solo QRP. It is a fantastic plan. Like I said at the beginning, if you are self-employed and don't have any common law employees, you need to get onto our website, which is NuViewTrust.com. If you want to go to NuViewTrust.com/soloQRP, it will take you directly to the landing page for the Solo QRP product. It's very inexpensive. It's only $300 a year. So this is there's providers out there that sell it for $1,000 and $2,000 and $3,000, but they're basically selling you the same thing we can and do. So our plan's only $300 a year for you to have it and maintain it. If you choose if you want to be more hands-off on the retention, you can outsource that through us, and we can help you with that. So let me pause here. I've got another question that came in. It said, if I put my traditional IRA into a Solo Qrp and then convert those funds to the Roth IRA, does the conversion to the Roth trigger a taxable event? Great question. The answer is yes. So if I take $50,000 that I have in a traditional IRA, and let's say tomorrow I set up a Solo QRP, I can take the $50,000 in my IRA because it's a non-Roth, and I can move it into my Solo QRP. Once it's in there, then I can do a Roth conversion. So I could simply take the 50 grand that's in the traditional inside my Solo QRP, and I can designate it as Roth. It will trigger the taxable event. Anytime you move pre-tax money to a Roth, you have to pay the tax on the amount that you're converting at the current tax rate. So it's something that you can do. You want to be very considerate of from a tax standpoint, but it's a strategy that we've seen deployed many, many times. All right, I will pause for just one more second or so and take any questions that may come in before wrapping us up here. All right, well, since I don't see anything else there, all of our contact info is on the screen. You can email me at jason@NuViewTrust.com if you have any questions. Remember, our role in this process is to be your custodian and plan provider. If you want us to hold the assets of the 401k QRP, we can. If you want to hold them yourself, you can. One of the major benefits is the choice is yours. So let us know. Just remember that things have to be established by 12/31. So if you're interested in this plan, I would encourage you to reach out to me at jason@NuViewTrust.com via email or at 877-259-3256 so we can make sure that we're setting everything up to get done in time and done right. Let me see if that's another question. Oh, I got a couple more. It says, currently have an E-Trade account. Is there a link or instructions on how to use my residual funds in my 401k account to invest in my E-Trade account? So if you have an E-Trade account that is in your personal name, you cannot use it to invest the dollars of your Solo QRP. You would need to open a new E-Trade account in the name of your 401k plan and then move the money that way. The next question is, I am self-employed. Can I make HSA and purchase health insurance? So yeah, sounds like the cart may be a little bit ahead of the horse. You would need to go out and secure high deductible health insurance and then set up the HSA. The HSA is the easiest part. The hardest part is the savings account, or sorry, the health plan that you choose. So that's something you want to make sure you give yourself maximum time to do. Any other questions? Great. Well, you've got our contact info and my email there. If you guys want to reach out, we'd love to get you set up with your plan by 12/31, so you can take advantage of depreciating, reducing your taxes as best as possible in 2020. So, without any additional questions, I will use this time to simply say thank you for joining us today. Hopefully, you learned a little bit something. And if there was any questions that I didn't get answered or that you didn't ask, but that come to mind, please email me and I'll be sure to get those addressed. So thanks everybody and take care.